All right, a shift in the startup world is underway. Now, it's about who's funding them and how they are running now. Over the last few months, Indian startups, especially those backed by family offices, business houses, and private equity firms, have been raising significant capital. We're talking about mature startups, seasoned operators, companies with 5 or 10 years of balance sheets, attracting institutional checks big enough to change how they operate. But it's not really going to the rest of them, which is the curious question. Some of India's most promising startups today are floated or backed by legacy business groups as well. So what's the trend here?
Right, not because of a good idea, but because they're ready to scale within the structure. That's why they're receiving that kind of funding. And data released by a research firm, Venture Intelligence, that estimates that growth PE stage companies have doubled their PE VC investments to 1.1 billion in Jan and Feb of CY 2025. Now, where does that 1 billion number stand? Well, if you go back 1 year, the last year number was 594. So with just that comparison, it does look like a very, very positive number. But we'll go a little deeper right here on the show. The PE investment exclude those from any real estate sectors. Why the biggest shift in the Indian startup story might be who is funding these companies, where is the funding taking place, where is the funding not taking place, and the larger question of how do we increase risk appetite. With every new round, there's also an old way of doing things coming into the fray. Who do we have to discuss this with us today and break it down?
So lovely to have Pranav Chaturvedi here with us in the studio. Good morning, Pranav. Thanks so much for coming by and sharing a cup of morning coffee with us.
Thank you, Sonal. Thank you, Toya.
Of course.
So he is the founding partner and MD for Favcy Venture, am I saying that correct? Yeah, and Builders. So Pranav, when we look at these numbers, we spoke a little bit earlier about what this really say about a larger trend. You spoke about a 2022 shift being sort of an influx point. Take us through that.
So the VC space, we can actually divide that into absolutely two phases, from 2015 to 2022. And from 2022 onwards. So from 2015 to 2022, worldwide we had about $1.2 trillion worth of investments that happened. And if you see that from a perspective from in 2022 itself, there was about $460 billion of investments that went in just the startup ecosystem worldwide. Put that in perspective, in India, we're talking of about I think 46 to 48 billion dollars that came in one single year. And that was the blow off year. That was the year when all the VCs started actually, just putting behind all the capital that they had on the lagging trend of digital. So digital was going away by 2022. The other reason from 2022 onwards is essentially the investments have now, we're really at that edge where we're looking at where should we really now invest in. AI has taken over. So we are seeing that founders will actually now start building companies with AI, may not need that much kind of capital. And therefore, we are also shifting our focus towards traditional companies. We are looking at manufacturing, we are looking at, essentially family offices have come back and saying that, hey, do we now digitally transform ourselves? So all of that is now happening in the ecosystem. So I think 22 was a pivotal year. And from there on, I think we had a funding winter. The numbers that you see today are still very small compared to what the numbers were in 21 and 22. But we are seeing that, investments in, again, AI, robotics, traditional companies, manufacturing, I think those are the kind of trends that we have started seeing.
Okay. So before we go a little deeper into the numbers, Pranav, I think a great comparison point would be interesting here. So compare us to, I know the typical comparison question is always China. But maybe compare us to China, compare us to one more country, just so we can understand, because it's possible that 2022 to 2025 trend is something that's taking place globally, that confusion in the markets, or is that an India-specific phenomenon?
It's a great question. So from 22 onwards, I think one thing that happened worldwide, and I'll put India in the center because we're talking more for India. But worldwide, I think there is this kind of uncertainty on what is the next big trend.
Okay.
Institutional investors, which is also considered smart money in the terms of VC space and the private equity space, essentially, just invested whatever they had in their existing companies by the year 21-22. And today they are looking at and saying that, where should we really go and invest? If you look at India itself, all the international institutional investors have left the country, more or less, right? What is left are Indian partners who are now essentially juggling with Indian LPs and are saying, let's go local, let's go to tier 2, let's go to tier 3, let's find what are the kind of things that are very, very Indian. So that's the kind of trend we are seeing in India right now. From a China perspective, I think, they are taking on US on AI in a big way. And I think, we've always found the Chinese data to be, sort of smoke and mirrors. But we are seeing that they're taking on US in a big way. And US in itself is saying that AI is going to be the next investment, next big trend. So that's what they are focusing on. So just to give you a perspective, the AI race right now, I think US is winning. China is, just next. India is waiting and watching. We are investing, but we are investing more or less smaller dollars compared to what is happening worldwide. And these dollars are going right now in, more of AI agents than just the AI stacks. So that's what we are seeing.
Okay. So AI consumption, India being one of the biggest markets, but not really place where we are building it. But the funny part, it's a catch and mouse, right? Because when you say that we are waiting and watching to see what startups actually do with it, what founders actually do with it, you're not really putting your money in there. So is this a phase of caution that I'm hearing from you? How will this really work? How will India really match up and catch up?
So it's again, it's one of those questions that always puts us in a spot, right? Because we say that we are the risk takers, but let's look at it from a capital perspective. India doesn't have that kind of capital. Right, and when you're looking at meeting the kind of capital, even at a peak, when about $600 billion were being spent in a year, we were doing what, 10% of that. So at our peak also we were just 10% of what the global money was, and this 10% was also contributed majority by international investors only. Now when they are not there, we are now saying that what is the government going to invest in, what are these family offices going to invest in. That's going to be just a very small patch of the total number of investments that can happen. So while we are trying to be risk takers, while we are saying that we will try and win the AI race, the fact is that we don't have that kind of arsenal right now to really take on these big guys. So I think that's where we are. But
can I get a flip side to this?
Yeah.
Because of Trump in office now, there is a lot of caution in the US. That caution not really translating into money being pushed in, is that what you're saying?
I think one could be Trump, obviously. The second, I think, is that overall everybody is waiting and watching. They've just invested large dollars, and if you look at equities life scale and life journey, it's a decade-long process, 15 years, 20 years. So when you take a perspective of 2 years, 3 years, it's a very short term in the sense of what is the life cycle of an equity.
Okay.
So over the last 2 years, I think 2 years, if you're just being a little uncertain, that's absolutely okay. Because you will then start finding the right trends to really back and to double down upon. But yes, one is obviously Trump. The other is that digital has had an end of an era in 22. And the third is obviously how the new companies will form, what's going to be the next take.
Sure.
Those kind of things are happening right now. So we are right now just amidst that.
Okay, so can we ask you a little bit about people's behaviors, investors' behaviors? I want to ask you, one of the criticisms I read most frequently about the sector, unfortunately, is this belief that there's a lack of risk appetite, and in particular when it comes to early stage. So I want to understand from you, what will it take to increase that? We talked a little bit earlier about the categories that are already receiving investments.
Yes.
So we talked about AI.
Yes.
But let's talk a little bit about the categories that generally have a hard time getting that investment. Why is there a lack of risk appetite? How do you analyze the problem? Is it inherently Indian, or is that not the right way to look at it?
Again, India, if you look at it, traditionally, whatever scale has happened, has happened because the VCs were able to take right bets based on what the international partners were doing.
Right.
Right. So what happens here, Toya, is that when you are investing in an early stage company, you're looking at who's the next big check writer. And the next big check writer is looking at who's the next big check writer.
Yeah, everyone, okay.
Right? So everybody's just looking who's the next big check writer and who's my elder brother who's going to come in and support me. Now, from an Indian perspective, for example, SoftBank, Tiger Global were the largest check writers. They have, fortunately, unfortunately, no longer writing large checks. There were these international investors in Sequoias and Matrix, and those have left the country, but their Indian partners have now taken up the mantle and they are now investing, so as to say. So overall, if you look at the supply chain of capital from an early stage to absolutely late stage, it's kind of broken now.
Okay.
Right? So early stage investors like angel investors and family offices that were writing, immediate checks, they tend to actually also work with, institutional money, right? So smart money, we call it the smart money. What is the smart money doing? And when the smart money's supply chain is completely broken, you really don't know what to and where to write the checks.
Okay.
So that's what's happening at the early stage. But what is the, just to give you another perspective, I mean, this is maybe sounding a little pessimistic, but to give you a little optimistic story on this, because of all of this capital that came in, what also started happening was that a lot of know-how went and a lot of knowledge on how to build companies has gone in. That's got democratized. Technology has got democratized. There are no-code solutions that have come in, right? So founders, on the other hand, and I'll give you a little perspective on the founder side. Founders are now saying that, do we really need large capital? We can build good companies, we can build positive economic companies, we can build unit economic companies just by building it correctly. And what I'm seeing as a trend now is that the founders are coming together and they are trying to say that we are going to run a longer race. We are going to run it for, let's say, 10 years. We are going to possibly also build a company that we can sell in 3 years, 4 years.
Okay.
So you will see a rise of founder operators happening. So that's the kind of trend shift that we are seeing. The other shift that you just mentioned in the beginning.
Overall, you're saying maturity of the sector.
Much mature.
Yeah.
The founders have become mature. And one thing that you started the program with was on family offices.
Right.
That is fortunately the backbone right now. So we are seeing, large family offices coming in. We are seeing family offices saying that, hey, we are not going to be looking at who's the next big elder brother for us. We are going to write a check. We are going to write a larger check. And we are going to take this company through to an IPO.
What kind of ties does family office investment usually come with? What are the drawbacks there versus, companies like SoftBank coming in that have now left?
So you invest in the public markets. I'll give you an example from there. If you do invest in the public markets, I'll take an example, a parable there, right? So if you look at just pure equity, because all of this startup ultimately is an equity game. So if you look at just pure equity investments, right, we say that you should be investing for the long run, right? 10 years, 15 years, 20 years. There's a derivatives market, right, which is like for the traders, right, which is essentially an intraday or weekly trade, etc., where the institutional investors, the smart money is winning, and the retail traders are trying to find what the institutional investor is thinking so that they can make money. Now put that in perspective of startup ecosystem, it's exactly the same story, right? In a longer time frame of 10 years, 15 years, 20 years, if you invest, build well, you will be actually able to build better quality equity. But from a perspective, when you look at a VC's time frame, it's just 3, 5, 7 years, which is almost as the same as a derivatives market in the public markets, right? So they have to, or all of us, I mean, I'm on that side as well, but all of us have to actually invest because we have to give returns to our limited partners, right? That's what we are looking to do. And for that, a capital change is needed. Coming to the question now, and I made this as a base, coming to the question on what family offices, I think the positives are a family office can write you a large check initially, will take large equity, but will help you to build a company that they can essentially take you to an IPO. A great example, and I think I'm an absolute fan of Sanjeev Bikhchandani, right? Absolute fan of him. Because look at it, he is a traditional, he now comes as a VC because he's got a VC firm, but he is a traditional family office thinker, invests a large check, asks the founder to take a large check, give equity upfront, right? But helps them build the company properly, and then he's a master investor. So I think that's the kind of advantage you can get if you get to the right family office. They'll take a 25-26% equity, but they'll help you build, they'll help you grow, they'll help you keep
It's a very
your units
fine
positive.
analogy, but in the world of Shark Tank, we're talking about all of this, which is quite fascinating. We've come towards the end of our discussion, but I do want to understand if somebody watching this today right now is looking for funding, is starting out or starting up, as they say just now, what areas do you think are VCs and investors gung-ho about? What are they positive on?
Okay. From the Indian perspective,
AI we mentioned, of course.
from the
apart
Indian
from that,
perspective,
yeah.
apart from AI, which has been the flavor, I think we are seeing agri-tech essentially like a massive play where we can invest in, because again the supply chain in agro is still broken. We are seeing investments happening in digital transformation of traditional manufacturing. That is something which is very exciting, personally for us as well, but also for a lot of VCs. Fintech hasn't lost its flavor. So if you're in the fintech, we are still finding reasons, because in India, essentially India works on loan, right? So fintech is never going to go out of flavor.
Yeah.
We are seeing again a lot of supply chain optimization kind of companies coming in. India again has a large non-tech population, so D2C also we believe hasn't gone out of flavor yet. So we are seeing a lot of good brands still potentially getting built. The likes of Zeptos and Instamarts, etc.
Quick commerce.
Quick commerce have given way to a lot of good D2C brands coming up.
Correct.
So we are going to see that, and of course anything in logistics, EV as a space is still not dead yet. We believe that there's been a motion in EV, but EV is a great space. I'll take a contrarian punt and I'll say education is still not dead yet. So we'll see a lot of mergers and acquisitions happening in the education space. If you are an early stage founder in education, this is a great time to build, to sell. Don't try to build it for 15-20 years. You can find a 3-year, 5-year horizon. Build education products right now that you believe will be useful by the larger education things. Because whenever you see a hype in the market, that's the time to get out of the market. Whenever you see a market which is absolutely dull, great time to enter.
Okay, I want to ask you one more question, Pranav. Tell our audiences, in the last few years, we've seen, for example, the Kamath brothers come out with an entire enterprise to fund younger startups. I want to understand Y Combinator and just what Y Combinator has given birth to in the US. A lot has been said in positive praise of it. What would it take to see more Y Combinators in India?
So this is a question which is very close to my heart. So as Favcy Venture Builder, we are trying to be the Y Combinator for India. Indian dynamics are a little different.
Let's just tell audiences what Y
I
Combinator
was
is
just
for
gonna
a
say,
second.
Okay. So Y Combinator is essentially now considered de facto the Harvard and Wharton for startups.
Yeah.
Right? It is the largest accelerator program and an absolutely wonderful program, because not only do they write check sizes, they have a great network which really propels a founder to actually start growing in things. They have a great alumni base now, and they have great knowledge and knowledge transfer and know-how aggregated for founders to succeed. So I think Y Combinator is the de facto mecca for anybody trying to build something useful. In India, acceleration was till now a part of what was essentially seen as a not-for-profit. You had incubators and accelerators funded by the government, not coming with their own models. I'm seeing that trend changing. As I said again, as a venture builder today, one of our biggest programs, 1 to 10 Accelerator, is essentially like a Y Combinator model, where we have, over the last 10 years, essentially brought all education together. We've not only digitalized this, we brought AI into it. We are now saying that you can have your own platforms, learn on your own. We've got like a mentor pool of about 3,500-4,000 mentors. We've got 5,500 investors investing with startups. So we've built sort of that kind of a platform, nowhere close to what a Y Combinator is achieving, but we've had very reasonable successes. And we are now saying that India, essentially, again, you combine all of this, you get into media, you give them a little bit of PR, that opens up doors for founders to actually start, building together with institutions from day one. So that's one part. The second is that we're always trying to find something which is very relevant and differentiated. When you're working in an accelerator, you know what are the kind of problems your customer has. But when you get access to like good mentor pools, you understand whether my product is differentiated or not. And that's something which is very important. So you learn the kind of tricks of the trade there. So that's something that is very useful that happens at an accelerator. And then there's always strategy and how you should be building your teams. How should you be financially prudent? How should you be looking at what are the kind of teams, how do you motivate them? What are the communication strategies? So there's so much that a founder can pick up over the first 15 months of building a startup. And essentially, it just helps you to organize, get a good check, and start winning in the market. So that's what. And Y Combinator, as I said again, we all aim to be Y Combinators at some point of time. So.
Well, here's wishing you get closer to that goal. Pranav, thank you so much for joining us and shedding light on such fascinating subjects. And I hope this was helpful to all our viewers watching to understand which way this is actually going.